Welcome to the 2024 Economic Depression and Preparation Channel. I'm your host, Tony. Thank you for joining me on this Tuesday, October 29th, 2024 edition. Please be sure to subscribe to this channel for the latest financial news interpretation. I appreciate everyone's support. We're talking about job openings. CNN Business had an article saying that job openings fall to their pre-pandemic levels as the U.S. labor market continues to cool down. So despite the rate cuts that we've had, the 50 basis point rate cut by the Federal Reserve, conditions are still softening in the labor market and also prices are still rising, even though the good news is inflation is not rising as fast as it was last year at this time. It is still holding steady. And so many people have been cutting back on spending, excessive spending, and been tightening their belts as we continue to go through the rest of this year, hit the fourth quarter here after the elections and into 2025. So job openings continue to fall to 7.4 million, landing back to near pre-pandemic levels. And these job openings are not being, a lot of them are not being filled. A lot of you notice there's a lot of job cancellations also. It's almost as if the companies are doing these jobs, putting the postings out just to get the tax breaks and to get the federal and the state regulations and tax breaks and incentives to come there. And then once a couple months or a year turns over, they either fire those people or give them a severance package and start the whole process over again. Let me know what you're seeing in your area. Are you seeing more? You see these signs all the time on school buses, on restaurants saying now hiring, call this number, blah, blah, blah. But, they're just collecting. It seems like these places are just collecting a lot of job applications for a database, and not actually hiring maybe 5% of the applications that they actually receive. Let me know what you're seeing. Dow Jones was down a little bit today. S&P 500 and the NASDAQ was up a little bit, but nothing too crazy. But record gold prices continue to defy the markets here, as gold has actually been making moves. It's steadily above 2,500 now for the last 2 or 3 weeks now. And so, people have been saying that gold is a hedge against inflation and protection, and it's starting to act that way, starting to go up consistently now. And many people are getting into that. And then also the poor man's cousin of gold, silver, has been going up too as well. But new record gold price, according to bullionvault.com, shrugs off rising real rates on U.S. job slump and trade deficit surging. So gold price is leaping to fresh record highs in all currencies today on Tuesday. And this is defying expectations, so we have to be careful. Like I said, I'm not one to pick one or the other or to tell you to, invest in this or invest in that. But it's a good sign when gold and silver is going up, actual real money, real, valuable things that the dollar used to be based on is going up. And so that's a good sign. Gold price and dollar jumped up to 27.65 per troy ounce. That tops the record there for gold already. And so that's good news. And so U.S. confidence, also more good news, according to Reuters.com. U.S. confidence continues to rebound in October. So, hey, we're all feeling a little bit better. It could have been a lot worse. Honestly, if if we were really into a severe recession, we were already supposed to be, according to some economists, into some kind of recession by this summer. That did not happen per se. We got the 50 basis point rate cut, and now we're out of October almost. And so they're saying that, the media is saying that, hey, more consumers are feeling better about this economy in terms of the prices in the market. But we know that that's day by day. Consumer confidence index rose to 108.7 this month. That's from an upwardly revised 99.2 in September. So it's rising. It rose a good steady 7 or 8 points. Hey, that's good news there. The share of consumers who viewed jobs as, quote, plentiful rose to 35.1% from 31.3% in September. Some 16.8% of consumers said jobs were hard to get, down from 18.6% last month. So that's some good news, but we need more good news, because Morgan Stanley's CEO says that the era of zero interest rates and inflation is, quote, over. The Fed cut its benchmark rate by 50 basis points earlier in September, as we discussed. That's the first rate reduction since March of 2020, since the pandemic began, some 4 years ago. Now, he says that, the CEO says that, and that's a very, great thing to say. Unfortunately, we have to keep these rates lower. It won't go to zero. He's right about that. But unfortunately, these rates are going to be going lower. And unfortunately, it's going to hurt savers and people who have been saving, with T-bills or has CDs or a savings account, high yield savings account. All that rates are going to be going down, unfortunately, because we can't service our debt at a high interest rate. If we really want to raise interest rates like Paul Volcker style, rates should be at like 12 to 13% right now, interest rates. So that's not going to happen in the next year or two, unfortunately. So rates are coming down, maybe not to zero. He's correct about that. But it will be coming down. The CEO is right about that, but it will be coming down to at least, I would say, 2 to 3%, somewhere around that in that range when it's all said and done. This is regardless of who gets in office or what. This is the financial thing, the financial prediction that I'm making. Regardless of who's in office, the rates are coming down. But will it be too much, too many rate cuts too late? That's the problem. They're playing catch up right now because inflation is still there. Just because it's not rising at an extremely high rate doesn't mean that it's all gone away. And you know that, and and I know that. So continue to downsize, continue to, only spend on things that are necessary and needed. Obviously, food, water, shelter, transportation, utilities, and emergency fund and stuff like that, and some leisure, because you got to have some fun. You can't be all stuck in the mud like some of these people are that are preppers and all of that. So just remember that as we continue to go along, job openings will continue to get less and less. And also, we're going to have a combination of prices still steadily increasing, even though they won't be increasing as fast. But as more money gets printed up for this infrastructure stuff, regardless of what shakes down with the elections, and as more money gets printed up for other things that are going to be happening between all of us in the 50 states, that means the prices are going to continue to go up. And as more money gets printed up in these cities, as these cities or some of these sanctuary cities are going to be taxed to the limit, they're going to raise taxes on regular Americans, and that's going to drive prices up even higher for goods and services. And so you're going to see a domino effect here. So be on the lookout for that. Continue to prepare. God bless you, and I'll talk to you very soon later on this week on Thursday when we get the jobs numbers and see how they've doctored that up and fixed that up for the week. Thank you. God bless. Take care.